Okay, hello traders and welcome to this live intraday strategy webinar on SB Trade Desk. Today is March 22nd, Wednesday. Michael Boutros here with you this morning. Graham, Mark, Pooja, Steve, Sarab, good to see you guys here in the room. So, on the docket for today, obviously you're seeing a pretty steep, well I guess considerably speaking to what we've been experiencing over the last few months, sell-off in risk assets. You did see U.S. markets weren't really that heavy, but again, relatively speaking, you saw a 237 decline in Dow. S&P was down by nearly 30 points, totaling 1.12% drops on the session. That being said, we've been looking at some equity markets that have been very interesting. The Nikkei one that we'll go over today, we've been highlighting that key resistance since last year. We've been off every day since we've tagged it. You might have seen Jamie talk about that yesterday in the swing update. But certainly there's a lot of things to look at. That initial decline, what I'm trying to say is that initial decline that we're seeing abroad the board is coming into some of the initial areas of support. So an area of which you could see some give back, some kickbacks, some fake outs that people will start to buy into again before we resume. So we'll go over some of those. On the docket for today, DXY, we'll go over first as always, then we'll go over to yesterday's update on the Kiwi crosses. Obviously you have the RB and Z on tap tonight. We'll go over the implications of that interest rate decision. So Kiwi, Sterling Key, Euro Key, Aussie, Dollar from last night. Previous update, I do want to touch base on the Sterling, Sterling CAD, and Kiwi CAD. Also great crosses to look at today. And then from the previous day's update, we do just want to touch base on the Dollar CAD and the Euro Dollar. Obviously, all the dollar crosses are still in focus. Even Dollar Yen, we'll add that to the list. And then crude gold, DAX, and the Nikkei. So we got a packed list for today. If I missed anything, guys, or if you have any specific trade setups that you personally want to go over, I know that there was a question on rice yesterday. We had a good time going through that chart. Feel free to throw them on the message board. All right. Or was that sugar yesterday? Anyway, here we go. I digress. Here is the relative performance for the dollar heading into the U.S. trade session. You can see a split performance. Excuse me. Yen really top performer. Aussie worst performer. That came into support last night. I highlighted on the piece. We're still holding that major support on the near term. Just a confluence region of both fib levels and basic trendline support. That seems to be holding for now. I still like the short side broadly speaking. We'll talk about that. Pound. Euro down 0.2 and 0.26% apiece. Same thing on the loonie here. Kiwi is going to be tight heading into the RB and Z. I don't really expect much into this until we get into the close of the session. Here's what the dollar looks like. Take it to the daily chart. So yesterday's 100 spot 02, the 2015 high day close. We talked about that region for a while here in the webinar. We did push through it and we closed below it. Now you're getting some kickback here. Pooja, Euro Yen, gotcha. You're getting some kickback here, but you're still below the lower parallel. I'll show you the near-term chart in a moment. So look, initial resistance on this move higher. You're not getting any divergence. Everything looks good in my mind, but if you do get a move higher, initial resistance, what would want to cap the low would be right back at 100 spot 02. On the near-term chart, you got a whole lot of confluence there as well. Okay, there's that full, the near-term decline, the pitchfork that we've been working with. There's that lower parallel break. It's been resistance already. And then there's the 2015 high day close at 100 spot 02. So on initial bounce, if we stretch into this region, I want to see this hold into the U.S. trade session. Keep in mind, it's also that initial Asia low that we made to start the week. Just a nice area of which you'd want to find initial resistance if the breakdown's going to, full on spill here. Subsequent downside targets unchanged, 99.53, just a former swing low. You're really looking for 98.99, which was a gap and is still an uncovered gap. And the 2016 open comes in down at 98.70. So targets on the downside are pretty clear. Right now, I'm trying to gauge whether this divergence that we're seeing is going to lead to a larger rally or whether we're going to hold. At the end of the day, we need to adjust this retracement to the new low. And if you do that, highlights 100 spot 24, sort of the breakout. if we do max that 100, you got another 25 pips before you start to look at any structural resistance on the dollar index. Largely speaking, right now, heading to the U.S. trade session, I'm looking lower, sub 100. That's going to be my near-term bearish invalidation. All right. Keep in mind, we've had a pretty big decline. It's going to get stretched, okay? So don't be too surprised if you see some consolidation, some sideways action. But largely speaking, you want to be cautious down here. So with the DXY, I think you're looking at a very similar thing with the euro, which we'll take a look at again. 60% of this is comprised by that. But I do want to take every currency on its own merits. So for Kiwi dollar, here's what the Kiwi looks like heading into the RBNZ. First of all, the implications for the RBNZ are as such, guys. I mean, they're not expected to change on rates. We are expecting them to hold interest rates at 1.75% as they have been. You know, there was a note that came out this morning from the New Zealand Institute of Economic Research, and basically what they were saying is that the RBNZ is going to take a more, you know, wait and see approach, steady as she goes. They're going to say that economic growth is solid and that underlying inflation pressures are lifting. But the most important thing, and this is a quote I'm reading right off the note, it says, this suggests little need for further interest rate cuts, but there is no need to rush into interest rate increases. So what does that mean? And I'm just taking a little segue here, but my point is this, from a price action standpoint for us, what does that mean? Well, guys, that means that the markets are basically on a seesaw. Okay, think about two kids on the playground, seesaw. We're expecting no change. The doves are pretty well quelled here. The hawks are pretty on the other side. Everything's stable. We're expecting them stable as she go. You know, there's economic or there's threat from the global economic outlook. And if there's a change, whether it's slightly more hawkish or slightly more dovish because we're expecting such a neutral read, that's like one kid getting off the seesaw and just letting the other kid drop. And that's exactly what I think could happen in price. Because the market expectations are so, I mean, I've been combing through just looking for headlines. There's not even anything to talk about as far as like what expectations the RBNZ could shift to in light of any new data or any incoming economic prints. So the point being, from where a price action standpoint that Kiwi is trading at right here, we've been talking about this region. We came into the start of the week wanting to stay bearish below the median line. We got through the median line and we're just sitting right there. You had, you know, markets or the momentum signature really holding below 50 here, unable to break through, coming from oversold territory after a big spill. So the way I'd want to play this, on a knee-jerk reaction on a rally in Kiwi dollar, you're looking for the 100-day moving average, which comes in right at like 71.06. And then 71.30 is what I want to stay below. These are areas of interest for possible exhaustion, possible entry on the short side. Okay, if this thing just collapses, 69.52 is still the same level we've been talking about for 2 weeks. It's actually been a pretty decent pivot. That's still the same level I need to get through to sort of validate resumption of the broader downtrend. As we were talking about yesterday with Elliott, you know, this could be a very clear third wave. So we could be in consolidation on the break into wave 5 here, would be one way to interpret this. But as far as near-term price action, here's what we've been following, and here's what we looked like last night. So I could bring up the chart from earlier in the week here on the 19th, but it's the same exact level. We were right here talking about resistance. We broke through, and that offered some support for a couple of days. Here's the breakthrough in overnight trade. The weekly open comes in at 70.10. Look for this range break heading into the RBNZ. Again, if we spike higher, 71.06, 71.30, like I said on the daily chart, areas of interest where you could see some exhaustion. You want to look for some divergence. You want to look for some that radical spike and the pullback, I think would be a decent play. And again, you know, a break below the weekly open would get this thing started, like I said yesterday, and then, you know, 69.52 is really what you need to clear, in my mind, to get this thing going again back on the downside. Subsequent targets are at 68.60, 68.61, and then the yearly open at 68.27 converges on slope support. everyone clear, at least in, what my game plan is, or what the game plan is, I guess, heading into this release? Again, it could be a complete dud, guys. We could come out. They might be really, really cautious and cautionary tone. We might not get much. But like I said, with that expectation baked into the market that we're not going to get anything, that's like two kids sitting on that seesaw. And, if we do get a shift in tone or policy, or there's specific remarks made towards, certain policies, you could see for sure a knee-jerk reaction offer some play here in Kiwi. Recognize that Kiwi short here is dollar strength, okay? And if we do see DXY give us that break above 100 for a near-term recovery, it would either fuel this fire. If not, again, you're going to really just rely heavily on what the market reaction is off of RBNZ. If you want to stay out of the dollar, which is not a bad idea, there are some other crosses, and we highlighted them yesterday. Next up on tap is Sterling Key. Any questions on this before we move off? Focus range right now is here. Threats to the downside below 71.30. Break below 69.52 opens up subsequent downside targets. Sterling Key. Looks like this. The major thing I wanted to highlight with Sterling Key, and we haven't looked at this in a few weeks. If you go to last night's update, you can see that the last time that we updated this was actually way back here on February 1st. But even if you go to that February 1st update, you can see that the daily chart is ridiculous. This is the slope support that we were looking at in early February, or former slope support, now resistance. We sat on it for a while. Wasn't really the cleanest break. We talked about it, but there was the break nonetheless. We've taken out the former high day close. We're basically right here. Okay? Let me go back to that. Sorry about that. We're basically right here right now at the 200-day moving average. Fast forward to March 21st, and here's what we look like now. So we look like last night. And I wanted to highlight this region because it's pretty important. You got the 2017 open. Just so happens that that's also the 2017 high, opening range high, excuse me. That comes in at 177.98. Let's just call it 78. Just right there is, in fact, the 200-day moving average. Just below that is the 786 retracement of the entire decline from the highs that you made there last year, or late last year, excuse me, into the December high. So that encompasses all of this year's range as well. 786 retracement into that 2017 open gives you a nice zone of resistance. Add to that basic slope support. It's only a 2-point touch trend line, but if you take it and extend it off these highs, it governed price action for a good 4 days, 3 days here before, again here today, trying to make it through. Unable to close, right? Unable to close. Here's what the line chart looks like. Doesn't get much closer than that. So any way you look at it, it's at resistance. My point is this is a huge breakout potential because this is the pivot zone. If we max 178, I do think this thing has lots of upside potential. With the same respect, on the near term, for guys like us, there's a reactionary play here, right? We could play the kickbacks off this on resistance. Anything you take on the short side, I've been super light. Recognize that you're playing with a pair that has a massive ATR. A quarter of the daily ATR still puts you above 43 pips at this point. And you just want to be a little bit more cautious on this one. But that being said, there's a threat here for a pullback. Ultimately, I'd rather play the longs. But you can see that you're getting some divergence on the daily chart. You're coming into a big resistance zone. Again, you have some former swing lows here. Even on the swing lows, okay, we haven't made a close above. So point being, this 100 pip range is pretty critical. This 50 pip range, rather, is pretty critical here for Sterling Key. And this is a decent story to play for the RBNZ, especially if you get a breakdown in Kiwi. Since we like the long side of Sterling, and it seems that we've made a break of some near-term resistance ranges, if we get weaker Kiwi, or Kiwi just drops off, this would be a play I would be very, very much interested in. Now, on the near-term chart, here's what it looks like on the 2-hour. Let's go to the 4-hour first. Just zoom out a little bit. Okay, here's basic, again, just a basic trendline support. You're looking at this in the daily chart. Here's that resistance range, 786, 2017 open, all the same levels. You could see price action in this pair tends to be a little bit more chop, tends to be a little bit more stretched. When you make the runs, they're typically, 100, 200 pip runs. So, use, not for the faint of hearted, like I said yesterday, if you're going to get involved in this one. But for those of you who've been with me for a while or who've been trading for a while, this is, these trades can be our bread and butter for a time. So keep your eye on that resistance range. Threat is for a near-term pullback off that, but broader focus is if we do pop through this, you have a lot of room. Initial target 78.60, 79.90. You're basically looking at 180, and then 81.50 would be a larger 618 major level of a broader range. Any questions on Sterling Key? An interesting pair, something we'll be watching tonight as we get into the RBNZ rate decision. All right, that is Sterling Key. Next up is Euro Key. Here's what Euro Kiwi looked like last night. That's Sterling Key. Here's Euro Key right here. And here's what Euro Kiwi looks like right now. The daily chart is not really my favorite part of this setup. I just wanted to offer you kind of some, that's Euro Yen. We'll come back for that for Puja. Where's Euro Key? Here we go. I just wanted to give you some reference for where we are. We've been following these slope lines ever since basically mid-2016. You can see they've been very fruitful on the low side. Nice pivot here from that low from back March of last year. Basically, this is the median line I'm looking at right now. Not the most convincing one, but you have a touch, resistance, overshoot. It's now support. That same median line, okay, is converging on the 200-day moving average, and loosely fitting, it's also the median line off the lows. So a region of which you kind of want to at least look for some near-term support. Now on the intraday chart, you can see a clear consolidation pattern, lower high, higher low, and we're basically going to be looking for a break of this. Again, another pair that I would actually be interested in on Kiwi strength for tonight. So if the RBNZ comes out on a more hawkish tone, you see Kiwi rally a little bit with where Euro is. I wouldn't be too surprised to see some near-term weakness take this right back into support. The broader trade, however, does remain constructive above 151. So as long as we keep 151 as key support here, I think on a drawback, if you get a strong Euro key, it might actually be a nice opportunity to fade that weakness in the pair. As far as trying to get long Euro key, I have my reservations, but the broader picture remains constructive. Even let me take a step back. My reservations are this: if you do see a topside break, okay, I wouldn't want to hold it too long. I do think you get a decent run, you get a new high, that would be a nice 5-wave pattern to the upside, but you don't want to go nuts with it because it's been quite a stretch, and that's not a reason not to be bullish, guys. And I hate to be doing exactly what I tell you not to do, but on this type of stretch and where we are, at least what we're seeing in risk assets, I'm kind of, I don't want to get too aggressive on Euro Yen just yet. Love the upside. I think we see 55.80. I think we see 57.60, to be quite frank with you, this quarter. But right now, you need to respect this consolidation pattern. If you get Kiwi strength, look for support in your 52.30 range lows for the week. This pocket right here. Again, bullish invalidation 51, topside break of 54.50, last week's high. A little bit higher, you had that 50 line. I'm not really going to stress that, so I'm kind of just going to keep my eye on that last week's high, which is the monthly high, and then subsequent would be 55.80 right here. So we have a pair scenario for Kiwi weakness. We have a pair scenario for Kiwi strength. We have a clear-cut near-term range in the Kiwi dollar, all set up for the RBNZ later tonight, and no one's expecting anything. So if you do get something, Remember that analogy. Any questions on the Kiwi crosses? We'll go over one more Kiwi cross, Kiwi CAD later in the session, but I do want to take a quick segue into Aussie. Here's what Aussie dollar looks like. I highlighted this yesterday in the webinar. We talked about this key resistance range, and lo and behold, here we are again with another kickback. We're already a couple, more than 100 pips off the high. This region, 77.35 into 77.56. 77.35 is the high day close from last year. 77.56 is the 88.6 retracement. Also the swing highs from back here in August. And then you had basic trendline resistance right off the highs that we made from last year. So look, there was a lot to look at in this region. On the strength and the sheer veracity of the rally, we talked about hesitation. Sometimes hesitation leads to lost opportunities. And for me, that's what this was. You know, I caught some of it, but definitely nowhere near the amount that we should have, especially in the site, in fact, that we actually highlighted it and looked at it here in the webinar. But anyway, pretty nice reversal candle yesterday off that region. Here we are. We probed below the monthly open and held. Near term, this is support. I'll show you in the daily chart, in the intraday chart in a moment. But the broader picture still remains, I think, from a deeper correction. 1, 2, 3, 4, 5 wave pattern to the upside. You'd at least look for some sort of near-term correction or sideways movement in Aussie for the next few days. So here's what it looks like on the intraday chart. Okay, and here's where we were last night. Okay, nice little pocket of support there. This is a newly added median line formation just off the last reference points we made for the last 2 weeks, highs. You can see that the median line here, perfect resistance, resistance, break, support, break, fueled the drop. And that's exactly what you want to see when you're drawing your initial slopes here. So the lower parallel converged just lower from that 76.50, which is a basic 38.2 of the advance. Add to that basic trendline support off the lows. So there was clear-cut, you know, cause to expect some sort of near-term rebound off that 76.45, 76.51 level. The actual low was right around 40, and here's the rebound to the upside. Look for a resistance at the median line. I was talking about the monthly open initially, right this pocket right here. So let's call it 76.80 into like 76.90 as initial resistance here for Aussie on a bounce higher. And you'd look for some short signals beyond that. Bearish invalidation at this point, even for the near term, needs to be right back up at 77.35. Okay, at this point, now that converges on upslope, downslope, and that major key level that we've been butting up against for over a year now, or almost a year, right? Since August of last year. Huge region, huge region. I should really move this shaded region just for you guys to make this clearer. The November high is just a level I want to note, but it's really this. Here, let me just move this over. It's really this region that's the focal point of resistance for Aussie. All right, feel free to take a quick snapshot of this chart if you need an update on Aussie dollar. Again, there's a quick camera button in the top right-hand corner of your screen. See some new faces in here. Feel free to do that at any point during the webinar, guys. So if you need to reference these charts, you gotta have them at your fingertips. All of them are the same charts that are also provided in the intraday update. So if you just want the newer price action, as it were, this is where you want to take it. So a downside break, by the way, if we do get entries right back near the median line, or even on a stretch into 77.35, which I hope doesn't happen, but if we were to, you're looking for 76.20, you're looking for 75.90. I'll be a little more cautious at 75.90. It's the 618 retracement. It's been a decent pivot in price, but also if you look kind of below that, or there it was, you have some swing highs and swing low pivots here. And I kind of want to see that hold if the broader range is going to still be respected here in Aussie. So you have some clear-cut targets on the downside, but sub 75.90, I'd use a little caution on the near term. I'd be waiting for more of a prominent bounce off that region. Okay, that is Aussie. Making good time. Next up on the list, that's 2, 3, 4, 5, Aussie. We got sterling, number 6. British pound. Okay, is the breakout getting tired, guys, or what? What do you think? So here's my opinion. You have a basic trendline resistance. Who highlighted this? One of you guys highlighted this to me yesterday in the webinar, right here. It actually looks like it did something, and it actually looks like it is doing something. So I just want to highlight, you got a good eye there. That's a good line to keep in mind. It is offering something. Remember, it's only a 2-point touch, so we want to respect if it closes above, just not really focus on it. But at this point, I am going to keep an eye on it. I'm going to go ahead and get rid of the previous one we were looking at. And the daily chart kind of just highlights a break of the monthly opening range of the 2016 low day close. And if this trend line is still intact, you're going to be looking for a squeeze, okay, in this sort of near-term range. Our focus is still higher, and I do think that there's plenty of room to the upside here in the British pound. Near term, though, I'd be mindful of that. The intraday chart is all I'm looking at with this. Bear with me one moment. I just want to see what this looks like. Okay. Okay, it's too early for that. But anyway, here's what the intraday chart looks like. And here is what we looked like earlier in the week. Okay, so we started off the week, or earlier in the week, this was back on the 20th. We were talking about the resistance bounce that we got off that 2016 high day close. The kickback did hold 23.44 as support, 23.45, which is right here, did hold as support. And then here's the rally and plow through on those stronger CPI numbers we talked about yesterday. The 618 held. We couldn't get one 4-hour close above it. We teetered with a 2-hour close above it, and we got a couple of 1-hour closes above it. Long story short, this is your range of focus heading into the close of the week here. I am looking for a little bit more of a reaction in this pair to the downside to get back long. I would love to get some sort of entry as close to 24 as you can. Sort of trying to keep it hold against the monthly open, the weekly open, both of those come in at 23.80 into 23.90, this region. But again, near term, it does look kind of tired. Momentum signature is just not there. On a breakout of this confluence region, you'd want to see a little bit more of a press. This is that slope that I was just looking at in the daily chart. I have it here. The reason I kind of want to keep it in mind is just because you did get some decent pivots on the median line. And then even the 50 line here did offer a little bit of a hold right into the Friday close. We actually popped through earlier this week, but we were holding. That all converges right in this pocket. So if a pullback happens into here, again, you're getting some divergence. A break below would suggest correction. I would be looking for possible entries around this level. 125.78 area of interest. 126.78 into 126.80. Big region. It's a long-term 236 and a 100% extension off the low. That would be a great region. But broadly, still looking higher in the pound, to put things simple. And if you get Kiwi weakness, pound Kiwi, man, I think that could rip. I think that could rip. Hey, Graham, what's that link you sent over? I will take a look at it after this session here, but moving right along. Any questions on pound dollar? Levels remain unchanged from earlier in the week. Okay, next up on tap, pound CAD. What a breakout, my friends. We were talking about the potential for pound CAD weeks ago. And it was based on this 166 region, 165.90 into 164.90 to be exact. It was a bigger region, but it's such a critical area of resistance. We probed into it, and we've been holding that all year long. It was, right into the yearly opening range. It was right near the yearly highs. Such a major area of resistance. It was very exciting to see this. Now, the break, we talked about it earlier in the week, wasn't all that convincing, or we talked about it late last week. What is this pound CAD? Here we go. It wasn't all that convincing at first because you got a lot of pullback. You didn't quite get the stretch into support to test it as former resistance as support. But boy, did you make a break, and we took out all those topside targets into July low. You're still looking for a major stretch, I think, a little higher into 67.57, 67.90. That is a massive region of importance. You have so much there. You have the 200-day moving average. Here's the daily chart. Nature of a breakout, pure and simple. Here's your yearly opening highs. Here's your 618 retracement of the decline from that high that you made in November of last year. 100-day moving average, consolidation, break. Okay, if we do that, one thing that you always want to take into account is just a basic measured move, which would take you into 70.40 on a break of this. Oops, that's not the top end. Here we go. Seemed a little too high. 69.03. Okay. If this consolidation break would give you, well, it's not if, the consolidation break gives you an upside target. This is classic technical analysis of 169, a measured move into this region here. So as an initial approach, I love the fact that this confluence region comes just ahead of it. Gives me time to, take out any long exposure that I might have. On the pullback, you know where to find support. On the stretch higher, you know where the confluence key targeted region is. Okay? And this all holds and stands true while above 65.20. The origin of the breakout, those 2016 low day close, major key pivot in price, 100-day moving average will be there in just a matter of days. So very clear, okay, as far as pound CAD is concerned, from where we're coming from on the breakout to the upside, 67.57, again, still major area of resistance. Looking at this from the near term, here's the nature of the breakout looked like early. There was our, favorite entry right there, the monthly open. You had former trendline resistance. You had a basic 38.2. Intraday chart shows us not quite making it down there. We missed it by just a little bit, 64. So right now the low was 64.76. So 10 pips off, then that thing just ripped. So long story short, confluence region there, the 50 line of the ascending median line formation, 764 retracement, decline off the highs, and a 1618 extension of the ascent all converge right there. So looks pretty good for sterling CAD. Keep in mind, you do have CAD CPI data heading into the close of the week. We are expecting an uptick in CPI, so that could curb some of the upside. Would actually be a really nice play if this thing just kind of drifted higher into that release. You get a decent CPI print for CAD. You get some CAD strength. Triggers a pullback in pound CAD off that key resistance at 68, 67.93 would be awesome. But again, that's just in a fairy tale world. From what the technicals are saying right now, stick with the game plan, stay constructive above that 64.60, the weekly low, looking for that stretch higher into key resistance. Now you're probably asking, Mike, would you be interested in short exposure off this region? Depending on what happens and when we get there, I actually would. The median line this median line at least has been some pretty decent as far as pivots off it. The confluence region of the Fibonacci considerations I think need to be respected as well. And yeah, I wouldn't be too opposed getting some kickback from here before continuation up into that 69 target. So for an intraday guy, shorter term guy, yeah, sure, I'll be looking for waning momentum up there. But as it stands right now, I'd still be rather buying pullbacks, looking for that stretch towards 67. Questions on your, what is this, a pound CAD. So number 7. Kiwi CAD, a very interesting pair that I brought up earlier in the week. I just wanted to give you guys a quick update on that. There's not much to talk about just yet. The whole focus of this setup that we had highlighted was the fact that we were coming into a key area of resistance. And basically, that's still what we're looking at. The area is defined by 94.22, 94.33. You have a basic 38.2 retracement, the 200-day moving average, the 2016 yearly open, all converging on this region. It's been holding as resistance for the last 3 days. We highlighted that region. It's still the game plan, okay? I'm looking to play short exposures off this near term. If we pop higher on RB and Z, by the way, I'll probably be flat. I am flat right now. I'm going to be flat on Kiwi crosses heading into the release, but I'll be looking for new opportunities. If we break higher, 95 is an area of great interest. The 618 retracement of the decline off the highs from February, which is the yearly high, and certainly structural resistance, okay, former slope support that we broke through, and just a good darn area to kind of look for bearish invalidation, look for a major resistance hold for a short side play in Kiwi. Now, your key support hasn't changed either. That's still 92.67. I stretched it into 93 because that 100 did hold on a closed basis pretty nicely. So watch this key area of support, and this is the break you need to get the validation for continuation of the broader downtrend. So resistance 94.33, bearish invalidation 95. Let's see if we can't get that hold. On the intraday, looks like this. Not much has changed. Not much has changed. Okay, there's that key resistance. We came back, checked the weekly open as support, which was the initial support that we noted, and we're still holding this region. So you have a really well-defined weekly opening range right below near-term resistance. If you get that pop higher, I'm not going to chase it. I'd be looking for exhaustion near here, but I'd rather be selling rallies in Kiwi CAD as of now. Pooja says my voice is cracking. Is anyone else hearing that, guys? Let me know if that continues. It might have just been the loose wire. All right. So here's the 120-minute looks like just for consideration. Again, you know, most of the range for the week has not been happening on a ping-pong basis. It was basically all this stretch right here. So wait for this thing to clear. It's going to be like Kiwi dollar in my humble opinion. We'll get Kiwi CAD in the archive. Pooja says it's better now. Oh, I'm sorry about that, Pooja. Yeah, Pete says no. Okay, looks like it might have been just on your end. Either way, I think it records perfectly on my end, Pooja. So is there specific questions you had on this that I could go back? Not a very popular pair, not a crazy ATR, but I do love the levels. I do love the levels. Actually, it's a good pair for if you're just getting your feet wet with more near-term stuff. Okay, and that is Kiwi CAD number 8. Moving right along, let's jump into some of the dollar crosses. We'll hit the commodities real quick, and I'll take any other questions you guys might have. Dollar CAD is first up on the list. We've been waiting for dollar CAD on my end, looking for that rebound. We've been getting the rebound. I was kind of looking for this to stretch just a tad higher. I don't think we're going to get it. But here's what dollar CAD looked like. So we talked about the threat for one more low in dollar CAD start off the week before making a more considerable rebound we want to sell. It kind of started to work out pretty decently. Hold on one sec, guys. I'm sorry about this. So we got the move lower, but it didn't last very long. Here's what it looked like, right? It probed right into the monthly open. It probed right into slope support, even got deeper and then ripped right through. The rally, just missing it. 134.26 into 134.35 was sort of the butter zone. It would have been a 618, would have been basic slope resistance, it would have been too clean. You're seeing some exhaustion here. I'm not really picking up much divergence on many time frames at all. I was looking at that this morning to see if it was time to kind of jump in. I'm still looking higher. I'm still looking higher, guys, for entry. If you're not short already, I wouldn't do anything from here. I don't think there's anything to validate the turnover yet. And you are sitting above the objective weekly opening range. So for me, that was all the more reason to wait for 34.35, 34, 34.25, this region here. So what do we do from here? I don't think there's a play yet. I don't think there's a play yet. I think you need to wait for that reaction. Like I said, you have some CPI data coming out of Canada later in the week. That might be the kind of trigger that you need, but I would need either a play up against this region here or a concerted breakdown, again, back below 33.18, this sort of zone here. Let's move this around a little bit. Clean it up. We don't need that, don't need that, don't need that. You know, when you start getting alerts from TradingView that you have too many drawings on your charts, you gotta sometimes just go back. Fewer is better. Don't need that. Okay, we'll readjust that to the new low. Ooh, highlights 34.30 now. And we'll leave that. So here, just a little bit of an amendment to some of the levels that we've been highlighting. Obviously, there's not been an update on this since, what day was that? The 19th? So here are the updated levels, guys, just for the real near term. There are about 30 pips on the targets, which is a little bit bigger than the ATR typically for dollar CAD. But I'd still be looking at that stretch near trendline resistance, near that 618. If we can get it, I'd be looking for exhaustion for sure. The broader implications of what we saw last week, can't be ignored. Questions? By the way, this is also a region I define as my near-term bearish invalidation. So if we do get on a rally, this thing rips through, like let's say 34.50. Don't get cute and try to fade it. I think that's, if we get above that region, there's going to be a domino cascade. Everyone's going to get washed out. So just keep that as your bearish invalidation level, sort of this 34.30, 34.50 region. With that being said, might be an area for nice entries. Okay, that is dollar CAD. We have crude inventories out at 10 o'clock as well, so do keep that in mind. Obviously, the propensity to move crude prices, which we'll talk about in a moment, they're at 10:30, excuse me, crude inventories today, which will also typically have a strong impact on loonie prices. That is number 9. Moving right along, number 10, euro dollar. Here is euro. My friend, the euro. I tweeted this chart yesterday, not really thinking we were going to get quite the hold that we got. I was hoping the kickback would be a little bit more, but you did get a 50 pip downplay or 50 pip move to the downplay off that region. Basic Fibonacci region of resistance, 50% retracement. This is off the decline that we made in November of last year to the lows that we made this year. Okay. It also was pretty damn close to the highs that we made on this stretch back in February. The February high actually came in right at 108.28. This retracement came in at 108.20. Okay. Add to that, if you go to the left here, it's the stretch low that we made in March of last year. Nice symmetry, right? Real nice symmetry. Look at my cursor. So, long and short of it, you could get some kickback from here. No big problem, which is why I think on a Kiwi strong story, I wouldn't be too opposed to playing Euro Kiwi short, right? Because Euro dollar's at resistance. You got Kiwi strength that could materialize on a knee-jerk reaction, but I ultimately want to fade that. And that's the same thing that I have here on the euro dollar. Ultimately, I'm looking for the kickback, but I do want to fade that. I do want to be a little bit more aggressive on the long side. From the swing side of things, obviously we're still holding longs on that. It was stops against 107.15 or 107.16, I think we have it. I might have mine a little bit higher, but looking for a stretch into, Jamie's looking for a stretch into 109.80, which is a little bit higher than what I'm looking at, but beautiful region nonetheless. 109.80, let me take that step back. He's looking for this, guys. This is what Jamie's looking for. I'm looking for this right now. On topside break from here, I'd be looking for the 108.72. That's the 2016 open. Also a very big, decent pivot in price. That's actually the stretch high from December. You have the 200-day moving average, and you have slope resistance. All converge here. So that's a region I'm looking for on a topside stretch above 108. Another 80 pips, another 90 pips will take you back into that 108.90, 108.72 region. On a breach beyond that, structural resistance for the current operative slope, 100% extension, just correction even, would take you into 109.83, and that's Jamie's target. Love it. So the levels are right on. I think we're both looking at the same exact thing. You want to stay constructive. Basically above 107 is a loose way to play this, in my humble opinion. Again, Jamie's stop is at 107.16. You have 107 here, which is the basic 618 retracement. But you're basically looking at yesterday's low. You want to maintain yesterday's low. It was an outside. It was not an outside reversal, but it was an outside candle, and certainly you're right up at resistance. So you're just looking for the playback to get back long. Here's what the intraday chart looks like. Even on near-term slope off the lows. Okay, here's the median line. Initial support, I'd be looking for right here. The weekly open comes in just lower. You stay constructive above 107. Topside targets, pretty clear. There is a Fibonacci confluence I did not note at 109.30 and 109.36, a little bit more near-term to keep an eye on. This is just a 618 extension off that low, but you're looking pretty good as far as the targets here on the euro. Any questions on euro dollar? That's number 11. Number 12, Gary, you read my mind. I just literally dropped my pen when I saw that. He said, hi, Mike. A short while back, you said to wake you up when the abomination reached 111.30s. Does it still pick your interest? Well, my friend, we're at 111.30s, right? So yes, 100%. I do think dollar yen could make a massive rebound off this region. I think, well, let me say this. I think you probably get it. Gary, this is just complete conjecture from my standpoint. I'm not even going to, let me take one step back and regather my thoughts. This is what I'll say, Gary. You're at support. I don't want to catch a falling knife. The risk markets are turning over, at least in the near term. But what we said earlier in the session, everyone's starting to raise their hands and be like, uh-oh, things are starting to sell off. And those things are now coming into some support, just as people are starting to get worried, which is usually the way it works. So I wouldn't be too surprised to see some dollar yen recovery. And why? It's because people are starting to get excited about dollar yen now, right? We always have to keep in mind the psychology of what the markets are doing and why the market's doing what it's doing, or what sentiment is doing, I want to say. So here's what I'll say on dollar yen. Yes, I told you to wake me up when we were at 111.30, 111.07. We're there now. So I'm glad you woke me up, Gary. How about that? Look, from a slope standpoint, that region becomes less significant because of the break that we're making. So like I said, I do think you probe a little bit lower here in dollar yen. I think you can get into the 110s. I do think you can get into, I don't want to see 108, but I do think you can get into like 109.80. This region here, you see where I have this highlighted? The lower slope. This is basic trendline support, trendline resistance, parallel off support, caught the exact lows. So that gives us some significance to this. This median line right here is just a parallel, but if you extend it off this low, look how many touches you had. Touch, touch. That comes in at 110.50 or so, 110.57. The lower parallel comes in at, I couldn't give you a number because it's going to be dependent on where we are in slope, in time rather. So like 109.64, 109.70 would be a decent region for me to look for some support. But yes, the reason I was saying, wake me up when we get to this region, Gary, is because it's such a huge pivot that both on the long side for a rebound, I would like a play, and Gary, both on a break below, that's kind of your free fall mark, right? So earlier we came here, we didn't quite get into it, we got the rebound. On the pullback, again, we couldn't quite get into it, and we got the rebound. On this approach, I think we break. Why? What's so different on this approach, Mike, that you think we would break? Well, a couple different things. On these subsequent drops, you didn't have much of a momentum trigger. If you take one off here, looks like we just broke. So momentum's at its lowest levels, certainly way lower than we were here. Second of all, the nature of the turnaround. This is the monthly open. You made a monthly opening range high into a critical resistance, and then you broke the monthly opening range lows and the monthly open. Objectively, Mike, you got to look lower. So there are all these things that are suggesting momentum on the rally basically held 60 as resistance. That's exactly what you want to see in bear markets. So there are all these hallmarks that, in my mind, continue to suggest we should actually be looking for a break of that region. So Gary, yes, the significance of the region, both as an inflection point, is also there, and that's why I think you look lower. On the immediate approach, heading today, the next few hours, look for support here. Absolutely. Here's what the intraday chart looks like. Okay, it's a basic 38-2 retracement from the advance off the lows. So right off the bat, Fibonacci consideration to take into account. This is an oversold territory, so I wouldn't start to fade yet, but certainly on a recovery above 70, if you get a decent trigger and a break of the session opening range, for, let's say for US, might be a decent recovery here near term. Let me get rid of that. I just want to get rid of this. I just want to follow this with you. This is what we've been following in dollar yen. There was the break last week that shifted the bias to the downside. Don't need that anymore. Clean this. Okay, there's those parallels again. Touch, touch, touch. Resistance once we get below. Support. Okay, that comes in 110.50, 109.75. 109.60 would be that secondary zone. Both areas of which on the break would be targets. On the lower bounds, I'd be starting to look for some more support. Gary, does that help on the abomination? I remember saying about the 113.60 area, everyone was expecting a bounce. Yeah. Well, it's funny how that plays out. It's funny how that plays out. Guys keep, he said it was too obvious. I mean, yeah, it's too obvious to us, Gary, because we're actually following the market. We're not following the story. And that's what we always have to keep in mind and bring it back. I get concerned when people jump on. They're like, hey, Mike, this is happening in the news. Da, 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 what should we do? Well, you can't trade it. You can't trade like that. Where's price at right now? I do want to know what's going on for sure. I'm watching wires all day, but trying to filter that into what the story of what people are doing, that's not what you want to do. So I'm with you on that, Gary. All right, let's pick up the pace. We only got a couple minutes left here, but I do want to go over some of the commodities, crude, gold, and DAX and Nikkei we must cover. So really quick, crude, you got inventories out at 10:30, so in just over an hour. Look, we broke support. It changes the picture for me a little bit near term because I do think you can drift lower. But I tweeted this chart yesterday, and I still think the broader picture remains. The risk for a rebound here in crude remains while above 47. I still think that. You could get a little bit lower now to account for slope and time, maybe like 46.70. But this is a break of the weekly opening range low. So I mean, I can't deny it. So it's got to possibly be another slope down, make a new low here before we start to rebound. Longer story, and you guys know what I'm looking at, is that weekly chart. And it's all going to be about how we close this weekly chart out. Okay, because last week we did spike below this too. So it's all going to be how we close this weekly chart out. If we close below the 52-week moving average, below the 236, below the 50 line of the ascending formation, you got to continue to favor the downside. Ultimately, remember, we are looking to sell this on a rebound because we broke the yearly opening range lows 2 weeks ago. So know the game plan for crude. Know the game plan for crude. I'm still of the mindset that You make one stop lower here, possibly on inventories today, but as long as you're above this region, the risk is for a more concerted rebound here in crude prices. Questions on crude? I hope I'm not being stubbornly bullish here, but usually if you're about to give up on a trade, that's when it's going to work out the best. I kind of feel like that's exactly where we were on Aussie as I was talking to you guys yesterday, just pleading with that resistance range, saying, look, this thing is ripped for so many days in a row, but I don't know, this is resistance. Kind of that give up feeling is actually usually when you want to press the trade. Moving right along. That is crude. Gold, just quick recap on gold. Look, kind of held that support yesterday. It was a little bit sloppy, but here's the topside break now, testing the 50% retracement of the larger decline from the highs that we made off the February move, or excuse me, the July decline from last year, this broader decline. So you're testing that 50% retracement, and then you have the monthly open right here as well. Just higher, you have that high day close and the upper parallel. So on the near-term chart, it's this upper parallel. On the daily chart, it's the high day close and this parallel. So could see a little bit more of a drift here in crude, in gold prices. Momentum's in overbought territory. It's got plenty of fuel behind it. I'd be looking for some exhaustion on one last stretch here near term, 52 into 1254. Ultimately, I'm writing the gold forecast for daily FX actually, guys, for the third quarter, or for the second quarter, excuse me. No, these are the third quarter, I think, third quarter forecasts. In any event, so the broader focus, I'm still looking for a stretch, okay? I'm be looking for weakness maybe early in the second quarter for a pullback, but I do think you get, a considerable bounce here in gold prices, especially if risk assets turn over. The dollar's been correcting, so I think the risk still remains to the upside. You've broken back above some, nice descending slope pattern. So the recovery could stretch as high as 1278, but you have to keep that broader focus, real longer term, still in play. For the near-term charts, keep things in focus. Right now, you're at resistance. Look for a kickback, possible support back along that median line, which has been a very nice pivot. Ultimately looking for one last stretch into this region here, where you could see a little bit more firmer resistance hold. That is gold. Number 14. All right, we got through everything today. DAX and Nikkei. Here's Mike, do you use SSI, and if so, can I ask your opinion about the current SSI for the abomination? So this is what I'll say with SSI, Gary. I don't like using SSI as a strategy. I like using SSI as just an added piece of information, another tool I can use to gauge sentiment. The important thing about SSI is sentiment. I don't really care what the SSI reading is. I want to see what the shift in sentiment. So Gary, when I look at SSI, I'm looking at increases and decreases in net long exposure. I don't care what the ratio is at. I really could care less. I just want to see what the changes in net long and net short positions have been, and whether there's been a build in open interest, meaning that change in net position has been people closing open positions or new exposure coming into the market with participants trying to fade a particular move. So that's how I use Gary, the SSI. It's not something, again, that would shake me out of a trade per se, but certainly if I'm looking to get into a trade and SSI supporting that bias, certainly that's fuel in the fire. That would make me press the trade maybe a little bit heavier as far as a leverage standpoint. Good question, which I do get asked quite a lot. But if we take a look at SSI on the dollar-yen at this point, you can see that 76% of traders are net long, and the SSI ratio is at 3.17. Okay, that is fuel to the downside. But the one thing that you want to know is that they've been net long since basically January 9th, so it's been a constant. Net long positions are 13% higher than yesterday, 11% higher from last week. Net short, 9% lower than yesterday and 30% lower from last week. So you're seeing a washout of the short positions as long positions are starting to build. That means traders are trying to fade this. That does keep the focus lower, Gary. But the thing that you want to note is this, man. This is going to be reactive to price. So what am I supposed to do now? Because dollar yen, SSI is pointing lower, I'm supposed to what? Sell here at the lows? It's not necessarily a game plan, right? It's more of a confirmation for what the broader bias is. Near term, this thing is going to bounce in price and start moving way before SSI is going to shift. So that's the one thing that we're always going to want to just sort of keep in mind. The DAX. Real quick, DAX and Nikkei, I'm over on time already. Here's what the German 30 looks like. I just wanted to highlight this because someone brought this up in the webinar a couple of days ago, and remember that slope line that we threw on? Literally tagged the high. Take that same slope off the lows. We were looking at this. Converges on the monthly open. Near-term support. Okay, near-term support, 11,831 on the DAX. That's going to be your break zone. Downside targets are pretty clear. If we do break below that, in my mind, that would be a monthly opening range break. It would also shift the near-term focus lower in DAX. That would be the first time you got a decent monthly opening range break to the downside for an equity market in Europe in a while, guys. So something to pay attention to as momentum continued to mark divergence and you have multiple trigger breaks. So certainly an ominous picture here if we do clear price below the monthly opening range here in the DAX. Take a look at the Nikkei markets. Very, very similar, but fast forward in the fact that we've made a break of the monthly open. We've made a break of the monthly opening range lows, and certainly from just a price action standpoint, this thing it shifts the focus lower. Shifts the focus lower. This is a resistance range we've talked about ad nauseum. 19,636, 19,676, huge Fibonacci confluence. You had trendline resistance, you had the 50 line, you had the former highs from last year, all converging here. Nice consolidation break to the downside. Your immediate near-term target is 18,907, maybe a little bit lower. You're basically looking at this lower parallel and the 100-day moving average. Key, major, critical, absolutely paramount support is going to be down to 18,584, 18,596. A break below this is going to be full-on, full-on correction mode. That'd be a break of the yearly opening range, which all has taken place in the January open. We still haven't cleared that opening range. So really big implications for some of these markets, guys, as we finally see some weakness and finally see some kickback in some of the risk assets and equity markets. Even here on the slope as well, you have a trigger that's clearly given out. If I can ever select the tool on the first try, like this, okay, it's a 3-point, 4-point touch. It's just got all the hallmarks. So don't get too excited yet. Watch for near-term support as we come into this key zone. Resistance is right back up at former support, 19,169. You also have the former swing lows, the monthly open, former trendline support. As long as we hold below that, risk remains lower in the Nikkei 225. I'm going to have to wrap it up there, guys. I want to thank everyone who attended. Gary says, okay, cool. Just wondered, as it's extremely at the moment, barring in mind, or it's extreme at the moment, barring in mind where price is. Thanks. Yeah, Gary, I'll keep you updated on the SSI metrics if it does see a big change. But you're right. We are coming off some extreme measures, which actually could be another indication that we could see a near-term rebound before it corrects lower. But at the end of the day, follow the levels. Okay, follow the levels. You're at near-term support. Respect that heading into the open. Ultimately, you're looking for a longer-term buy opportunity on a break into 110. All right. You're more than welcome, Gary, and I appreciate that. Guys, have a great session. Remember, Jamie's up at 12 later today with the midweek strategy webinar. And also, he'll be going over the upcoming webinar for the signals, guys, and the beta testing on that. So he'll give you more information on that webinar, which we will hold next week. Best of luck trading. I'll see you all tomorrow morning. Cheers.